Hello and welcome back. System1 is a company that develops, as you see here, develops technology and data science to operate responsive acquisition marketing platforms. And so you will see that this company is a very recent IPO, pretty much a few months ago, and its current stock price is 20. But if you take a look at the stock analysis chart here, you will see that pre-market right now we're about 16% higher. And so we are looking at the stock opening at about $23, looks like today. Now it has had a 1-year high of 37, so that was the highest one. And we are potentially looking to maybe trade or even buy this stock. This is a $1.6 billion stock. It's a relatively small company. But you will see here in the stock news, and that is important, why System1 was up 2%. 30%. It's after the omnichannel client acquisition marketing firm announced its earnings, pretty much the Q4 and fiscal year 2021 results. The street seemed to like it a lot, really, and this is why the stock is actually heading higher now. Now we do want to take a little bit of a look at the financials and see whether it makes sense to hold this company. And we will start off with the PE ratio here, which is 4.44. It's very low, and it actually used to be higher, so it's now trending much lower. You'll see that this is like limited data because this is a very new IPO. But the price to free cash flow ratio is negative, so the company is losing free cash flow, and that's important. We will examine why and what happens there. There's not much dilution going on, really. This is very marginal here, really. Just a few shares, and the free cash flow to total liabilities ratio here is again negative, pointing to the free cash flow being negative. Now the 5-year revenue growth is very limited here, and you would kind of want something better for a company of that sort that is very small and you look to have it grow. This is not impressive at all. Yet the net income growth is much higher, so at some point they were actually losing money. Now they entered profitability, doing a little bit worse in 2021, but still profitable. Yet they are losing free cash flow here. I'm assuming this has to do with capital expenditures. I'm assuming. We'll have to take a look. And the total equity growth of the company is growing nicely, so that's another good thing to see. And what's worth taking a look at here is definitely the return on equity, which is very high. It looks like you're getting a good return on the equity, which is like debt and assets that the company is utilizing here. And net income margins of 10%, I would expect a little bit higher here, but okay. And the debt to equity ratio points to a company that doesn't have much debt here. Okay, so let's take a little bit of a closer look and see what's going on with the financial statements themselves, because it really helps to dig a little bit deeper. Now, please don't bear in mind this is a minus 100%. This is actually a bug that I have submitted to my provider, API provider. All the other values are fine. It's just this percentages here that are somehow wrong. These are all 100. This is not correct. But everything else is correct. So, as you will see here, the revenue has been increasing for the most part, but in 2021 has been a little bit lower. But what I do want to see is the net income, which has fallen quite some from the previous year, really, but still it's positive, and back in 2018 it was negative. So the company is growing its net income slowly but surely, I'm assuming. I'm seeing, and so yeah, it's at least not negative for now, and it's not better than last year, but at least it's still positive. Now let's take a look at the balance sheet of the company. What I want to see here is and again, don't pay attention to these hundreds here, is the total assets here and the total liabilities, which bring it down to a total equity of $457 million. Now, we don't have any additional paid-in capital here, which is good, and yeah, we are not looking at a company that is issuing too many shares, and that's a good thing. Okay, so the next thing is the cash flow statement, which kind of tells us what the company is doing in terms of its operating activities here. So it is negative for 2021, but it used to be positive for 2020. And that's because of the net income for the most part, because it was less in 2021. Capital expenditure, somehow they're not reported here, but they are actually taking us to a free cash flow that is minus $1.24 million. Again, this is a very, very small company that will have its ups and downs, yet yeah, the free cash flow has been negative here and actually down quite some from 2020, as you'll see here. A little bit of stock-based compensation and some depreciation amortization also skewing it a little bit, but for the most part this is pointing to a company that has been doing a little bit worse in 2021, and that's a little bit worrying. But we could be okay with getting a company that has a 1 year slump. That can happen, yet we kind of want to examine what was happening in the previous years as well. So again, don't pay attention to this 100. This is going to be fixed. This is a mistake from the API, but we are going to be taking a look at the revenue growths here that we have, and the net income growths and free cash flow growths and margins for all of these, which are correct. These 100s are somehow a bug in the third party. So let's take a look at the revenue here. It's 53 and 16. We'll have to go with something that's fairly conservative. 10, 12 and 14 makes sense. The net income margin 2, 13 and 10. So we're gonna go, let's go 2, 5 and 6 here. And the free cash flow margin is we can go something like 60, 70 and 80 here. And then the annual return of 13 is what we want to be making. And if we hit calculate, you will see that our current projection results are way lower than the current price, and that has a lot to do with some actual financials here and metrics being all over the place, and you kind of have to go a little bit conservative to make sure. Now the revenue growth that I have used may be a little bit too low, but even let's just say that we are more aggressive here and we go 20, 25 and 30 because we believe the company will be doing better, although they had a negative growth here. It's not 100%, but it's negative, as you'll see from this one. And so when we hit calculate, you will see that we are looking at a company that had a low of 1.16, 3.15 and 6.27 for the max prices to pay here. So even for our high estimates of 30% revenue growth, we are still getting a price to pay that is much lower than the current price of the stock. So we are looking at a far elevated stock right now, which is trending, and you could potentially take a look at for a trade, but it wouldn't be a good idea to hold for a long time, is what I'm saying here. Hope you enjoyed the video. Please leave a like if you did like it, and remember to subscribe, because soon I will be giving access to this tool, and so you may want to be around when that happens. So thank you for watching this one, and I'll see you in the next video. Bye bye.